This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, we now turn our attention to various accounting schemes, as they are known, that have been designed by HMRC to specifically assist small businesses. Small businesses have specific problems when it comes to VAT. It may be in terms of cash flow. For example, their customers may take significant time before they pay on the invoices that have been issued to them, or they may also suffer a bad debt problem. And what that means is in relation to their cash flow. We know from our tax point studies from an earlier lecture that a business has to account for output VAT in relation to the tax point, and the tax point is usually the invoice date. So when an invoice is issued within a VAT return period, we then have to account for the output VAT in relation to the end of that VAT return period. We know that we've got to pay over within 1 month and 7 days of the VAT return going in there. Again, all done, of course, online. So what that means is if we have slow paying customers, or worse than that, we have customers who don't pay us at all, then we find ourselves as a small business having to pay out, as we discussed this issue when we dealt with the tax point, by the way, having to pay out output VAT in relation to a sale made, while not yet being able to collect any of the cash in relation to that sale made. And obviously, if we've got another payment, 20% VAT in relation to a sale, more cash flowing out, but without any of the cash on that sale coming in, that can quickly put us into a cash flow problem. So we have the cash accounting scheme, and that's a bit of a giveaway in terms of what it now means. And what it means, of course, is instead of us accounting for VAT by reference to a tax point, which is the invoice date, be that whether we sell, which is the printable issue here, but also when we buy, instead, we'll use the cash receipt date in relation to when the cash comes in. Now look at the VAT return period in which it comes in, and that is the VAT return period. That is the tax point in relation to when we have to account for that output VAT. So we're not going to have to account for output VAT and pay over that VAT until we've received the cash from the sale. Now that, clearly with the slow paying customers, ensures that we're not out of pocket with having to pay the VAT on the sale made before getting any of the cash from that sale. Equally in relation to bad debts, when we looked at that as an issue, impairment debts there, we knew that we may have to wait a significant time before having to account for output VAT on the sale, but the money isn't just late coming in, it never comes in. But we have to wait for at least 6 months before we're able to get that money back in relation to the output VAT that we've paid over. So we have this cash accounting scheme to assist small businesses. You can see on the heading here that it's both cash accounting and annual accounting. These are the big two of what are 3 accounting schemes designed for small businesses. I've split them out though, these two going together, because most of the conditions relevant to the application of each of these 2 schemes are the same. Whereas the size of business that we're talking about with the third and final such scheme, the flat rate scheme, the level of activity is a lot smaller. But that can wait for just a little while yet until we deal with it. We said about what the cash accounting scheme is all about, and we'll go through the notes in a moment. The annual accounting, well, a bit of a giveaway there, that we have seen recently that we can get into trouble with HMRC regarding VAT if we are either late submitting our VAT returns, which will normally be done on a quarterly payment basis there, quarterly basis. And we also get into trouble if we're late paying our VAT in relation to a VAT return period. So the concept of annual accounting is simple, in as much as we don't have to, and we will not be submitting quarterly VAT returns. We'll be submitting one annual VAT return. Within us, it will be some 2 months of the end of the accounting period concerned. Now, that doesn't mean, of course, that we've therefore got all of that time period before we have to account for VAT. We'll be making payments on account. But those payments on account will be predetermined based on the amount of VAT that we paid for the previous accounting period. So it makes it much easier to plan in terms of cash flow, because you know at exactly what points in time how much VAT will have to be paid out. You set up a direct debit to make those payments, therefore. You could make those payments, end of story, no problem. So you are not likely to get into problems in terms of late payment, in terms of default surcharge, in terms of, well, also there, of course, interest having to be paid and penalties having to be incurred in relation to the late payment of any VAT, let alone the submission of the VAT return itself, and that giving you problems entering into and continuing within the surcharge, the default surcharge system. Okay, let's look at the detail. These two, first of all. As we said, the cash accounting and annual accounting schemes are both available to small businesses. We will see the level of activity that we're talking in terms of the supplies made, the sales made by such a business that make them small for the purpose and therefore for the application of either of these two schemes. The cash accounting scheme enables a trader to account for output VAT on a cash basis. As we've said, instead of when we issue the invoice, what VAT return period did that go into? We now have to account for output VAT. We only have to look at when the cash comes in from the sale made. What return period does that fall in? Then in relation to it, we then have to pay our VAT. The scheme, as we've suggested, will normally be beneficial where either an extended period of credit is taken by customers. Frequently a problem for small businesses where they have larger businesses as their clients. And those larger businesses are large clients of those small businesses. And they know that. And therefore they can take advantage of their importance as regards their supplier by, if they need to, if they wish to, delaying the payment. Because they're not going to get too threatening because they need us as a customer. That's therefore very bad news so far as a small business is concerned. And this resolves that particular problem. It also results in automatic bad debt relief, i.e., instead of us having to account for output VAT when we issue the invoice, now only having to account for output VAT when the cash comes in. If the cash never comes in, sad though that is, at least we never have to account for output VAT in relation to that sale. Disadvantage, of course, is that input VAT will only be recovered in relation to when payments are made. So again, we're only going to get the relief in relation to our purchases, our expenses incurred, when we actually make the payment. So if we ourselves delay payment, then it's no longer for the tax point. When the invoice came in, when we were invoiced for that purchase, it's when we pay it. So the cash accounting looks at both sides, both the cash in and the cash out, as being the basis by which we will record and account for output VAT on the cash coming in and look to recover input VAT on the cash payments going out. Now, we mentioned there about small businesses, so we have to have a little look, and we do this simply by means of an illustration. It's just an interactive way of, as it were, teaching you what are the rules. I say teaching you, I'm going to read them out. You're the guys who are going to have to learn this. But at least, so far as these two schemes are concerned, they're mostly the same. So if we just look at that. Violet Limited, here are examples. So here we go. Violet Limited gives its customers a 30-day credit period, pays for most of expenses in cash. Violet wants to know what conditions must be satisfied before it will be permitted to use the cash accounting scheme and the implications of using the scheme. Well, we'll be able to operate the cash accounting scheme provided that its taxable turnover here in a period of 12 months does not exceed 1.35 million. And that figure there, the 1.35 million note, is exclusive of VAT. That's the VAT exclusive figure that we're talking in terms of. So that's a reasonable level in terms of taxable turnover that we're talking in terms of. So it's not just very small businesses. Again, some of us might consider 1.35 million exclusive of VAT is a fairly sizable business. But again, we're taking in, therefore, a lot of businesses as being eligible to operate this scheme. But you can only do that if the company is up to date with its VAT returns and VAT payments. We must be up to date. We show that we're a good business as regards our interaction with HMRC. The scheme, as we say, will result in the company's tax point becoming the date that payment is received from customers in relation to our sales, rather than when the invoice for the sale was issued. This will, of course, delay the payment of the output tax, and as we've said, provide automatic bad debt relief should a customer sadly not pay at all. Since Violet Limited, to come back to the specifics of this particular client here, pays cash for its expenses, the company's recovery of input VAT will not be affected. We'll get immediate, as soon as we pay, when we get the invoice basically there, we're making the payment, so we're going to get recovery of our input VAT at the earliest possible time. Another number that we need to look at, as much as the 1.35 million level of taxable turnover must be below that to join the scheme, then we can stay in the scheme until that level of taxable turnover, again exclusive of VAT, reaches 1.6 million. As long as we don't exceed 1.6 million, we can stay in the scheme, even though we've gone above the entry level of 1.35. But if we go above that 1.6 million level, then we have to leave the scheme and we revert back to our normal accounting in relation to what is the normal tax point. So that's our cash accounting scheme there, and as we can see, most useful in terms of those small businesses that have a problem in terms of collecting the cash from their customers and or have a problem with bad debts. Again though, even if that is the case, we've got to look also at when do we pay our debts in relation to our purchases, our expenses, because we don't get to recover the input VAT until we've made those payments ourselves. We've then got the annual accounting scheme. Now, the advantage here is, of course, mainly administrative, as we've said, since a trader only has to make one VAT return each year. Payments on account of the annual VAT liability are normally required. It will also allow for easier budgeting for cash flow. Again, the points that we've made, we're only now going to have to submit one VAT return, and as you'll see in the notes that follow, we'll have up to 2 months after the end of the accounting period in which to submit and pay that final amount of VAT payment. And we've also got the issue that for the accounting period in question, we've got certainty, because we know what was last year's VAT that had to be paid. We've got certainty over the payments on account that we're going to have to make during that period. So in terms of planning for the cash flow, we know, rather than it being subject to what sales and what purchases and expenses were incurred in any specific VAT return period. The illustration again here to illustrate, we've now got our business that wants to know the advantages of the annual accounting scheme. Well, we've just noted that, but we'll see it again. And when it will be permitted to join. The company's annual turnover is 450,000. Again, we're talking in terms of an entry level where our taxable turnover here for where it was before the next 12 months does not exceed the 1.35 million. So again, as with cash, we've got an entry level as long as our taxable turnover does not exceed 1.35 million. We can also stay in the scheme here until our taxable turnover goes above 1.6 million. Again, then we have to come out. What do we say it will mean? It will mean, in addition, another condition there, almost missed it out, is that we've got to be up to date with our VAT returns and payments there. And then we're entitled to join this scheme. Under the scheme, only one VAT return is submitted each year, and that's due within 2 months of the end of that accounting period. We said that we won't, of course, be able to just make one single payment up to 2 months after the end of that period. We're going to have to make payments on account during the period. And those payments on account are 9 monthly payments made on account, each being 10% of the previous year's VAT. Now I know 9 times 10 is 90%, not 100%, but there's a balancing payment that is going to be made then when we submit the VAT return, which must be within 2 months of the end of the accounting period. So each being 10% of the previous year's VAT, we'll know at this point what the previous year's VAT was, and those payments will be made in months 4 to 12. So our first one at the end of month 4, we've got to make that payment of what was 10% of the previous year's total VAT liability, and then continue with 8 more through to month 12. So in months 4 to 12 of the period, with any balancing payment, could of course be a repayment. Remember, we are basing the amount of VAT on the previous period. And as may have been the case in recent times, there may be the situation where sales are not as high as once they were, so we're still paying on last year's amount of VAT rather than what would effectively be lower levels based on this year's level of activity. But 9 monthly payments, balancing payment then to be made. That balancing payment, of course, then either payment or repayment, as we suggested, or we may choose to pay quarterly instead of monthly. We still have that option available to us there. Okay, so again, understand what they are, what they do, understand what are the rules that allow you to join such a scheme, and when you must leave such a scheme. The rules are the same here for both cash and annual. And what are the reasons why you might choose to join into the cash accounting scheme and the annual accounting scheme? So have a think about that just for a few moments and go back through that before we turn our attention to what's called the flat rate scheme, where this is very different. It's still for small businesses. And again, it is to assist what are now definitely small businesses here, to assist them in relation to the VAT payments that they need to make and as regards how we account for that VAT. As we'll see, it simplifies hugely the system of VAT, where the main problem with submitting the VAT return with all the transactions dealt with upon it is not the sales that you make, because you know what sales that you have made. You know what invoices you have issued, how much output VAT has been charged on sales. You know that. Where you get into problems, depending on the nature of the business, is about the recoverability of input VAT. We've seen in the section on output and input VAT that it's not a problem working out using the output VAT, subject maybe to prompt payment discounts being made, but it's not a problem on the output. But knowing where we can recover or not recover input VAT, that's the usual problem. That's what gives difficulty so far as these very small businesses are concerned. And what the flat rate scheme does is basically to try to remove that problem from us. So go back through those, try and pick up on what the issues are. You're not going to learn it now, you're just going to familiarise yourself with it. But of course, as with any what will be a learning exercise, as most of tax is, you're going to have to make sure that you have learnt those facts prior to walking into that examination room. Okay, let's have a look therefore at the detail of this so-called flat rate scheme. And the first point made, of course, is that this scheme, as with cash and annual accounting scheme, is optional, not compulsory. We can choose to go into it as long as, of course, as we are eligible. Now, we've seen what the eligibility levels are when it comes to each of the cash and annual accounting schemes. And we've already said in our introduction to this that the level of taxable turnover that we'll be talking in turnover, or indeed any turnover, in terms of the flat rate scheme is a whole lot lower. So what is that level that you will then need to learn? As we've said, it will simplify the way in which small businesses calculate their VAT liability, because what we will not have to do is to record all of the output VAT less the input VAT in relation to the sales and purchases and expenses of a period. We just apply a given flat rate percentage. That's based on the type of trade sector we're in, but you don't have to worry about that because it's got to be given to you in terms of your examination. So the scheme can be used if the expected taxable turnover for the next 12 months does not exceed £150,000. And that £150,000 here is exclusive of any VAT. That 150 is a VAT exclusive figure. There is then a higher level. If we go above that level, then we are obliged to leave this flat rate scheme. The business can stay in the scheme if turnover does not exceed 230,000. Note there that 230,000 is then inclusive of VAT. Bit of an odd one this, the 150 is VAT exclusive. As regards, that's the level of sales you must be below to be able to join into the scheme. But when your VAT inclusive sales exceeds their 230, then you are obliged to leave the scheme. The turnover figure that we're talking about is determined by the particular method used to determine the VAT whilst within the scheme, which, as we've just seen, could be on a cash basis or without the cash accounting scheme being used. The tax point would, of course, usually be an invoice date, an invoice basis being used. We've said what we do. We don't now have to record all the figures of output and input VAT on our VAT return. Under the flat rate scheme, a business calculates its VAT liability by simply applying a flat rate percentage given by HMRC based on, as we said, the trade sector, but given to you by the examiner in the examination question. And that figure, now this is what you do have to be careful about. What do you apply that given flat rate percentage to? And that is to total income, all of your sales, inclusive of VAT, and also including any exempt supplies. I said all sales there. So it's all of your sales made. If they're standard rated sales, then VAT inclusive figure, and we include not just the standard rated, the zero rated, but also the exempt supplies as well. All of our sales are included, and again, that is the figure upon which we'll then base the given flat rate percentage. As we've said, it removes the need to calculate and record output VAT and input VAT. We'll still be issuing sales invoices. Those sales invoices, of course, will still have to account for output VAT. We'll be charging the normal standard rate on what are standard rated taxable supplies there. So it doesn't change the price that we are charging to the customer. But then we apply that given flat rate percentage to that figure of total sales. As we've said, the flat rate percentage is applied to the gross total income figure with no input VAT being recovered. The flat rate percentage, it being a figure lower than 20%, looks at that type of trade in relation to what's the normal relationship between outputs and inputs and gives you the flat rate percentage. So one simple single calculation determines for any VAT return period what the figure of VAT will be that needs to be paid to HMRC for that period. And all that is your total sales for the period. A figure that should be very easily achieved. You know what sales invoices of whatever type of supply have been issued during that period. Add it up and multiply it out by the given flat rate percentage. As we said, the percentage varies according to the type of trade and the business that it is involved in. And as we've said all along, will be given to you in the examination as it is given to the trader in practice. There is one new thing that came in a few years ago. A new higher flat rate of 16.5% has been introduced for businesses with either no or only a small amount of purchases of goods. Again, it is not a number that you have to memorise or know where it is applicable. If it is applicable, you will be told that. But that again is purely for those businesses, just in case we've got any discursive work to deal with here in relation to such a question. Unlikely though that probably is. Students will not be expected to know where this rate is applicable, but will need to know how to use it and identify whether the flat rate scheme is worthwhile, which is most unlikely in these circumstances. If we've got a figure of 16.5%, that's a very high figure. The output VAT on your sales would only be a maximum 20%, so we're talking about very little input tax being incurred. Example, if a business makes taxable supplies of £100,000, excluding VAT, then it would normally have to account for output VAT of £20,000 and then reduce it by, obviously VAT exclusive 100, so 20% thereon, there's your 20,000, and reduce it by any recoverable input VAT. If, however, the flat rate scheme was adopted, then irrespective of the amount of input VAT incurred, the trader would make a payment of what's our VAT inclusive figure of sales, that's 120,000, at their, if this particular situation is applicable, 16.5%. If, of course, they gave you a different figure because this particular higher flat rate does not apply, it's exactly the same idea. Whatever is your total sales figure, you simply apply the given flat rate percentage to that number. But the exercise that you're likely to be asked to deal with is not just doing that calculation, because that is very easy. They give you a percentage, they tell you the makeup of your sales. You can therefore total those numbers up and apply the percentage to the total sales. That ain't difficult. But the issue then is whether or not it would be advisable. Is it worthwhile to join the flat rate scheme? Well, you're only going to do that, of course, if it reduces the amount of VAT that you would otherwise have had to have paid over to HMRC. So what you're going to have to do is, get your total sales, establish the VAT thereon by applying the flat rate percentage, and that's your flat rate figure. And then doing simply a normal fit calculation of output VAT for the VAT return period less input VAT for the VAT return period, and seeing what the actual amount would be. Whichever is lower would indicate whether or not for you, albeit just based on one period there, but whether or not the flat rate scheme would be a good idea, would have been beneficial at least in relation to that period, or would not have been beneficial. VAT at the rate of 20% is of course still treated as being charged. You have to charge the VAT where applicable in relation to standard rated sales. Where a supply is made, but where a supply is made to another VAT registered business, in that case a VAT invoice must still be issued. You've got to charge VAT, whoever your customer is, VAT registered or not, but you're only having to issue a VAT invoice there to another VAT registered business, still treated as being charged, and in this case a VAT invoice must still be issued. You've got to do that if it's to another VAT registered business because they need proof of the input VAT that they've suffered when they submit their own VAT returns. So of course you've got to give them the relevant documentation. Illustrations just to test out our newfound knowledge here, and again principally testing do we or don't we want to adopt this flat rate scheme. First one. Company has annual sales of £120,000, all of which are standard rated and are to the general public. The company's standard rated expenses are £6,000 per annum. These figures are inclusive of VAT. So remember, we always, when doing calculations as regards VAT, whether it's output or input VAT, need to know whether the given figure in the question is inclusive or exclusive of VAT. If it's exclusive, we're charging, as we've already talked about, 20%. in relation to the standard rated sales anyway. If it's inclusive, then the VAT is going to be 21/20ths of that amount. The relevant flat rate percentage for the company Snowdrop Limited is 15%. Using the normal basis of calculating its VAT liability, Snowdrop will have to pay VAT as follows. Well, we're told here that all of the figures are inclusive of VAT. That figure of sales upon which we base our output VAT, they're all standard rated, is 120, so we take that fraction of 21/20ths, and unsurprisingly, we come to that figure of £20,000 thereon. As regards the input VAT on any purchases, any expenses incurred, that VAT inclusive figure was 6,000, so 21/20ths of that, 1/6 of that, is 1,000. Therefore, output VAT exceeds input VAT by £19,000. That would be the amount of VAT payable for the period. If Snowdrop uses the flat rate scheme, then it will pay VAT of, well, what would that figure be? What is your VAT inclusive figure of sales? 120,000. Ignore what the purchases and expenses might amount to. What is the given flat rate percentage? It's 15%. Therefore, 120,000 at 15% would be VAT of 18,000. There we can obviously see that 18,000 is £1,000 less than 19,000, and on that basis here, there would be a saving attached to being within the flat rate scheme. In addition to the advantage, of course, of simplified administration, you don't have to spend time now sorting out what amount of input VAT you've suffered on each individual expense item and whether each figure is recoverable in full or in part. We've simply got one single percentage calculation to do in relation to the VAT return period. Equally, as none of the Snowdrop Limited customers are VAT registered, there will be no need to issue VAT invoices. We don't have to do that. Again, the individual customer, not being a VAT registered business, doesn't need it, so it simplifies the admin in terms of the sales procedure. Next one, and last one on this. We've now got a company, Primrose, that has annual sales of £96,000. Now we get a little bit more interesting with our numbers, of which 50% are standard rated and 50% are zero rated. All of the company's sales are to VAT registered businesses, and the company's standard rated expenses are £30,000. These figures are inclusive of VAT. Those figures inclusive of VAT. What is our relevant flat rate percentage for Primrose's trade? That's 6%. So using the normal basis of calculating its VAT liability, Primrose will have to pay VAT as follows. Now remember, we have got what are VAT inclusive figure of sales, and we've got annual sales that are 50% standard rated, 50% zero rated. So 50% of the sales are standard rated, and therefore we need to account for output VAT thereon. The figures of sales given are, as we have seen there, inclusive of VAT. The inclusive calculation, 21/20ths. So we'd have to account for output VAT of £8,000, and our expenses, the standard rated expenses, were 30,000. So input VAT, 30,000, VAT inclusive figure, 21/20ths we take, and that would be 5,000, giving us overall a figure of VAT payable of just £3,000 for the VAT return period involved. If we were to use the flat rate scheme, however, we'd have to pay VAT of, well, we now look at all of the sales, inclusive of VAT, 96,000. That would then be at the given flat rate percentage of 6%. 6% of 96,000 is apparently, hopefully I've got that one right, £5,760 there. And as we can see, that figure is a whole lot bigger than that figure. Clearly, the flat rate scheme is not going to be beneficial. As we say here, although it will be simplified administration, we're still going to be £2,760 worse off. We don't want to pay £5,760, whereas if we do our VAT return, we'll only have to pay £3,000. It's not beneficial. As we can see, that's an extra £2,760 that would have to be paid. And Primrose would still have to issue VAT invoices as its customers are registered for VAT. So there wouldn't be any administrative savings there either. Not that it would be huge anyway. Okay, so the flat rate scheme, always one where the calculations are more interesting, where you're going to have to compare what amount of VAT has to be paid over if you adopt the flat rate scheme as compared to if you just adopt your normal scheme in terms of dealing with the output VAT and the input VAT recorded for the VAT return period. Remember on the flat rate scheme that the given flat rate percentage is to be applied, therefore, to the total sales figure. And that means that where you have standard rated sales, that is the VAT inclusive figure. Not only do we include the VAT inclusive standard rated sales, we also include the zero rated sales, we also include any exempt supplies, any sales that we make that are exempt. It's total sales inclusive of VAT. Otherwise, on your normal VAT calculation, it's your normal issues. What is output VAT on? Is the figure of sales given VAT inclusive or exclusive? Is it going to be 21/20ths? Is it going to be 20% there? What is the figure? And again, how much of those sales, as we've just seen, how much of those sales are actually standard rated as compared to any other type of sale? And in relation to input, what expenses have we incurred? In relation to those expenses, what input VAT can be recovered? And the question is simply asking there for you to establish how much VAT would have to be paid over under each of the two schemes, and then set in such a way as to, again on an objective testing question, what amount therefore would we have to pay? Are we going to go with the standard? Are we going to go with the flat rate scheme or just adopt the normal scheme? And can we calculate those respective numbers and get the smaller figure to be able to answer the question? Okay, those are our accounting schemes therefore, and that brings this particular session to a close, leaving us with just one more session required of us, where we'll look at the final two areas in relation to VAT, an area that goes back to what we looked at in chapter 22, which was groups, where we have now group VAT registration to deal with. And we also have to deal with when we have a business trading within the UK that either sells overseas or buys in from overseas. How do we deal with that from a VAT perspective? All of that awaits us in our final technical chapter lecture, the final one to come. I look forward to seeing you then.